A beginner's guide to investing, different types of investments, and how to start investing. Investing is one of the most effective ways to build wealth over time. Whether you are saving for retirement, a major purchase, or simply looking to grow your money, understanding different investment options is crucial. The world of investing can seem overwhelming at first, but by learning the basics, you can make informed decisions that align with your financial goals. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Stocks. Stocks represent ownership in a company and entitle investors to a share of its profits. They are one of the most popular investment options due to their potential for high returns. Stock prices fluctuate based on a company's performance, industry trends, and overall market conditions. Investors can earn money through capital appreciation and dividends. Capital appreciation occurs when stock prices increase, allowing investors to sell shares for a profit. Dividends, on the other hand, are periodic payments made to shareholders from company profits. Investing in stocks requires research and risk management, as prices can be volatile. Beginners should consider diversification by investing in various stocks or using exchange-traded funds, ETFs, to mitigate risks. Bonds. Bonds are fixed-income securities issued by governments, corporations, or municipalities to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount upon maturity. Bonds are generally considered less risky than stocks, making them an attractive option for conservative investors. The interest rate, or yield, of a bond depends on factors such as the creditworthiness of the issuer and prevailing interest rates in the market. While bonds provide steady income, their returns are typically lower than those of stocks. Investing in bonds can be done through individual bonds, bond mutual funds, or ETFs that hold a diversified portfolio of bonds. Mutual funds. Mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers who make investment decisions on behalf of investors. Mutual funds provide diversification, reducing the risk associated with investing in individual securities. There are various types of mutual funds, including equity funds, bond funds, and balanced funds that combine stocks and bonds. Mutual funds charge management fees, which can impact returns. They are ideal for beginners who prefer a hands-off approach to investing. Investors can buy mutual fund shares directly from fund companies or through brokerage accounts. Exchange-traded funds, ETFs. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They provide instant diversification by holding a basket of assets such as stocks, bonds, or commodities. ETFs offer the advantage of liquidity, as they can be bought and sold throughout the trading day at market prices. They also tend to have lower expense ratios compared to mutual funds. ETFs come in various types, including index ETFs that track major stock market indices and sector ETFs that focus on specific industries. They are an excellent choice for beginners looking for a low-cost, diversified investment option. Real estate. Investing in real estate involves purchasing properties to generate rental income or capital appreciation. Real estate investments can be residential, commercial, or industrial properties. Rental properties provide passive income, while property values may increase over time, leading to potential profits upon sale. Real estate investment trusts, REITs, allow investors to invest in real estate without directly owning properties. REITs are publicly traded companies that own and manage income-producing properties, distributing profits to shareholders in the form of dividends. Real estate can be a stable and tangible investment, though it requires substantial capital and management effort. Commodities. Commodities include physical assets such as gold, silver, oil, natural gas, and agricultural products. Investing in commodities can be done through futures contracts, commodity ETFs, or purchasing physical commodities. Commodities are often used as a hedge against inflation because their prices tend to rise when inflation is high. However, commodity prices can be volatile due to factors like geopolitical events, weather conditions, and global demand. Beginners should research commodity markets thoroughly before investing, as they can be complex and speculative. Cryptocurrencies. Cryptocurrencies are digital currencies that operate on blockchain technology. Bitcoin, Ethereum, and other cryptocurrencies have gained popularity as alternative investments. They offer high return potential, but come with significant volatility and regulatory risks. Investing in cryptocurrencies requires using crypto exchanges to buy, sell, and store digital assets securely. Investors should be cautious and only invest money they can afford to lose. Cryptocurrency investments can be diversified through crypto ETFs or by holding a mix of different digital assets. Certificates of deposit. Certificates of deposit are low-risk, fixed-income investments offered by banks and credit unions. They involve depositing money for a fixed term at a predetermined interest rate. Certificates of deposit provide guaranteed returns, making them ideal for conservative investors seeking capital preservation. The downside is limited liquidity, as withdrawing funds before maturity may result in penalties. Index funds. Index funds are a type of mutual fund or ETF that track a specific market index, such as the S&P 500. They offer broad market exposure with low fees and minimal management. Index funds are ideal for long-term investors who prefer a passive investment approach. Since they mirror the performance of an index, they provide consistent returns over time without the need for active trading. Warren Buffett has famously recommended index funds as a reliable way for investors to build wealth steadily. Peer-to-peer lending. P2P lending platforms connect individual borrowers with investors willing to lend money. Investors earn returns through interest payments made by borrowers. Peer-to-peer lending offers higher interest rates compared to traditional savings accounts or CDs, but it also comes with the risk of borrower defaults. Investing is a powerful tool for building wealth and achieving financial independence. By understanding different investment options and implementing a well-structured strategy, beginners can embark on a successful investment journey. Whether you choose stocks, bonds, real estate, or cryptocurrencies, the key is to stay informed, diversify, and remain patient. With consistent effort and smart decision-making, anyone can become a successful investor. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.